the Ghost Week deception. December 23rd through 31st, 2025. While Western markets celebrated the holidays, silver prices collapsed to $75 per ounce on COMEX. Yet in Shanghai, Chinese buyers were paying $89 for the exact same metal, an 18% premium. During the lowest trading volume week of the year, 660 tons had already moved. The licensing restrictions were set for January 1st, and 300 tons vanished in October alone. This wasn't a market anomaly. This was a calculated execution. But here's what they didn't want you to see. Welcome to Financial Revelations. You know, in my years of analyzing markets, I've learned that the most important stories are the ones told when everyone else is looking away. If you've been around long enough to remember when a handshake meant something, when business was done on trust and information wasn't just noise, then you understand why hitting that subscribe button matters now more than ever. We're building something here, a community that sees through the smoke. And I'm curious, where are you watching this from today? Drop your location in the comments. I want to know how far this story is reaching. Now, let's decode what really happened during Ghost Week. The final week of December 2025 exposed something that shouldn't exist in modern financial markets. A price gap so extreme, it defied every principle of efficient market theory. On December 27th, the COMEX silver futures contract closed at $75.12 per ounce. Trading volume had dropped to barely 30% of normal levels. Western institutional desks were operating with skeleton crews. The market appeared calm, orderly, even bearish. But 8,000 miles away, a completely different reality was unfolding. In Shanghai, physical silver buyers were paying $89.40 per ounce for immediate delivery. Not for future contracts, not for paper promises, for actual metal, loaded onto trucks, delivered to warehouses within 48 hours. The mathematics here demands attention. An 18.6% premium, $14.28 per ounce, on a commodity that trades globally with established arbitrage mechanisms and centuries of price discovery history. This doesn't happen by accident. Financial analysts examining the data faced an uncomfortable question. If Chinese buyers would pay $89 for silver, why would anyone sell it in New York for $75? The arbitrage opportunity was obvious. Buy COMEX contracts at $75, deliver physical metal to Shanghai at $89, pocket $14 per ounce profit. Except nobody was doing it. The arbitrage wasn't functioning. And when arbitrage fails in commodity markets, something fundamental is broken. The registered silver inventories at COMEX told part of the story. Since 2020, these inventories had collapsed by 73%, from over 400 million ounces down to just 108 million ounces by December 2025. But headline numbers rarely capture velocity. The speed of decline matters more than the absolute level. In October 2025 alone, the Shanghai Gold Exchange warehouses lost more than 300 tons of silver, not across a year, not across a quarter, in 31 days. That represented nearly 40% of total remaining inventory, vanishing in a single month. Market analysts who track physical commodity flows recognized this pattern immediately. This wasn't normal drawdown from industrial consumption. This was panic accumulation ahead of known supply restrictions. The Shanghai premium wasn't just about scarcity, it was about timeline. Chinese industrial buyers knew exactly what was coming on January 1st, 2026. New export licensing requirements that would effectively lock silver inside China's borders. Any manufacturer dependent on silver for production lines faced a simple calculation. Pay premium prices now for guaranteed supply, or risk factory shutdowns in February when domestic inventory runs out. The decision wasn't difficult. Manufacturing executives across Guangdong province were authorizing payments of $3,000 above standard contract prices. Not because they wanted to, because the alternative was worse. A solar panel manufacturer in Shenzhen paying $89 per ounce today was making a cheaper decision than the same manufacturer trying to source metal at any price in March. After global supply chains had fully adjusted to China's export restrictions, this created the divergence. Chinese buyers operating under time pressure and supply certainty concerns versus Western traders operating under the assumption that prices reflect available supply. But here's where this story gets interesting. Western markets weren't acknowledging the scarcity signals. COMEX prices were dropping during the exact week when physical demand indicators were screaming shortage. The futures market was generating bearish technical signals. Trading algorithms programmed to follow momentum were triggering sell orders. Financial media was publishing year-end analysis suggesting silver had peaked. Yet the Shanghai premium kept widening. December 23rd, the premium hit 12%. December 26th, 15%. December 29th, 18.6%. Every day the gap grew wider. Every day Western prices dropped lower. Every day Chinese buyers paid more. This is what market professionals call a dislocation. when two markets pricing the same commodity operate on completely different supply-demand realities. Under normal conditions, these dislocations last hours, maybe days. Arbitrage traders close the gap. Price discovery mechanisms realign markets. But Ghost Week isn't normal conditions. Ghost Week is when Western institutional traders take vacation, when trading desks operate with reduced staff, when market surveillance drops to minimal levels, when algorithmic systems dominate price action without human oversight, questioning why prices are moving against physical fundamentals. Ghost Week is when 18% premiums can exist because nobody with authority is watching closely enough to ask why, and that's exactly what someone was counting on. 3 months before the Ghost Week divergence, a different anomaly appeared in global silver flows, October 2025. Chinese silver exports suddenly surged to 663 tons, shipments to London vaults, deliveries to New York warehouses, metal flooding into Western storage facilities at nearly double the normal monthly volume. The timing made no sense. On October 30th, Beijing had announced new export licensing requirements effective January 1st, 2026. Any company wanting to export silver from China would need government approval. The regulations were clear. The deadline was firm. The message was obvious. Silver was about to become much harder to move out of China. So why were Chinese exporters racing to ship metal overseas, right before losing their ability to export freely? Standard economic logic suggested the opposite behavior. If export restrictions are coming, domestic suppliers should hoard inventory, keep the metal inside China where it will command premium prices once international supply tightens. Every ton shipped to London in October was a ton that couldn't be sold at premium prices in Shanghai come January. Yet the metal kept flowing outward. Shipping manifests from Shanghai port told the story in detail. October 7th, 42 tons loaded onto vessels bound for London. October 14th, 68 tons shipped to New York. October 21st, another 75 tons departed for Swiss refineries. Week after week. The exports continued. Market analysts tracking these flows published research notes expressing confusion. Bloomberg ran a piece titled "China Silver Exporters Rush Before Restrictions." Reuters quoted commodity traders saying the surge defied rational market behavior. But these analysts were asking the wrong question. They assumed Chinese exporters were independent actors making individual business decisions. They assumed market forces were driving the behavior. They assumed this was capitalism functioning normally. They were wrong on all three counts. This wasn't market dynamics. This was state coordination. The Chinese government didn't just announce licensing requirements on October 30th. They orchestrated the October export surge that preceded the announcement. State-owned trading companies received instructions. Private exporters got phone calls from ministry officials. The message was consistent across the industry. Ship your overseas commitments now, move the metal before month end, fill Western warehouse shelves. The strategic purpose became clear only in retrospect. Beijing needed Western markets to feel comfortable about silver supply heading into December. If COMEX registered inventories were visibly collapsing in October, if London vaults were showing critical depletion, if supply shortage signals were flashing bright red, then Western traders would have started panic buying in November. Prices would have spiked early. Global industrial buyers would have accelerated their procurement timelines. The whole supply chain would have adjusted 3 months before Chinese export restrictions actually took effect. That early adjustment was exactly what Beijing wanted to prevent. The October export surge served as a strategic sedative. It calmed Western market anxiety. Those 663 tons landing in London and New York warehouses created the appearance of adequate supply. COMEX registered inventory numbers stabilized. Commodity analysts published reports noting that supply concerns appear overblown. Western markets relaxed. That relaxation was the entire point. Through November, silver prices traded in a narrow range around $82 per ounce. Volatility remained low. Investment funds maintained standard positioning. Industrial buyers followed normal procurement schedules. Nobody was panicking, nobody was hoarding, nobody was paying premiums for immediate delivery. Meanwhile, back in China, the domestic accumulation was already beginning. Chinese industrial buyers weren't sleeping through November. They were watching the calendar. They were calculating their Q1 2026 silver requirements. They were running supply chain scenarios for a world where imports would be restricted and exports would be licensed. And they were quietly building inventory. Not enough to move prices, not enough to attract attention, just steady, methodical, strategic accumulation. The Shanghai Gold Exchange warehouse data showed the pattern. November drawdowns averaging 8 tons per day. Nothing alarming, nothing that would trigger commodity analyst alerts, just consistent physical offtake, day after day, week after week. By December 1st, the trap was set. Western warehouses held metal that had arrived in October. Western traders felt confident about supply adequacy. Western markets were generating neutral to bearish technical signals based on stable inventory data and subdued demand indicators. But the Chinese industrial buyers knew something Western markets didn't. They knew January 1st was coming. They knew domestic supply would be all they could access. They knew 663 tons had left China in October, and that metal wasn't coming back. They knew they had exactly 31 days to secure whatever additional supply they needed. December was when the methodical accumulation would become urgent buying. December was when the 8 tons per day would become 30 tons per day. December was when Shanghai premiums would start widening. And December 23rd through 31st, Ghost Week, when Western institutional oversight would be at annual lows, that's when the real execution would begin. The October export surge wasn't just about moving metal, it was about positioning Western markets to be looking the wrong direction, at exactly the moment when looking the right direction mattered most. Beijing had spent October building the deception. December was when they would capitalize on it. December 23rd, 2025, 9:47 a.m. Eastern Standard Time. A sell order hit the COMEX silver futures market, 12,000 contracts, roughly 60 million ounces of paper silver. The order executed in 43 seconds across multiple price levels. Silver dropped $1.70 per ounce in less than a minute. Under normal market conditions, this wouldn't have created lasting impact. But these weren't normal conditions. Trading desks across New York and London were operating at 30% capacity. Senior traders had left for holiday vacation on December 20th. Junior staff were monitoring automated systems. The financial district was quiet, volume was thin, Ghost Week had begun. Wall Street calls this period the holiday doldrums. Trading volume typically drops 60 to 70% between December 23rd and January 2nd. Not because markets close, but because the humans running those markets disappear. What remains is a skeleton crew of junior analysts and algorithmic trading systems programmed months earlier. Those algorithms don't take Christmas vacation. They process incoming data. They identify price momentum. They execute predetermined trading rules. And during Ghost Week, they dominate market activity. The 9:47 a.m. sell order triggered a cascade. Momentum algorithms detected downward price movement. They generated additional sell signals. High-frequency trading systems identified the trend. They added selling pressure. Within 90 minutes, silver had dropped another $1.40. By noon Eastern Time, silver was trading at $76.18. No fundamental news had changed. No supply reports had been released. No demand forecasts had been revised. Just one large sell order during the lowest liquidity week of the year, amplified by automated systems. But here's what the algorithms couldn't see. At the exact moment silver was dropping in New York, physical premiums were exploding in Shanghai. December 23rd, Shanghai buyers were paying $86.30 for immediate delivery, a $10 premium over COMEX futures. Chinese industrial procurement managers were calling suppliers, solar manufacturers were securing monthly allocations, electronics producers were confirming delivery schedules. The January 1st deadline was 9 days away. December 24th brought another futures market sell-off, this time at 2:23 p.m. Eastern, right when New York trading was winding down early for Christmas Eve. Another 8,000 contracts, another $1.50 decline. Silver closed Christmas Eve at $74.92. In Shanghai, the premium had widened to $12. The pattern repeated with mechanical precision. December 26th, futures selling at 10:15 a.m. December 27th, another wave at 3:40 p.m. December 29th, the largest sell order of the week. 18,000 contracts dumped into a market with virtually no institutional buyers present. Each sell order came during specific windows, Asian trading hours when Western desks were closed. Afternoon sessions when what little Western institutional presence existed was minimal, times calculated for maximum price impact with minimum resistance. This wasn't random selling pressure. Random sellers don't time their orders for maximum market impact during minimum liquidity periods. Random sellers don't execute identical strategies across multiple days. Random sellers don't maintain disciplined selling patterns, while physical premiums are exploding in the world's largest consumer market. Someone was deliberately suppressing COMEX prices during the exact week when detection risk was lowest. The arbitrage opportunity was screaming. Any trader could see it. Buy COMEX futures at $75, take physical delivery, ship to Shanghai, sell at $88, $13 profit per ounce, on a precious metal with established global logistics infrastructure. Except nobody was doing it. The reasons were structural. First, COMEX delivery timelines. Taking physical delivery on a futures contract requires 30 to 45 days from contract execution to metal in hand. By the time a trader buying December 27th, futures could take delivery, it would be mid-February. Shanghai premiums might have normalized by then. Second, export licensing. Even if a trader secured physical silver in New York by late January, shipping it to China after January 1st meant navigating the new licensing requirements. unknown approval timelines, uncertain documentation requirements, regulatory risk that no arbitrage profit could justify. Third, counterparty access. Selling physical silver in Shanghai requires relationships with Chinese industrial buyers or trading licenses on the Shanghai Gold Exchange. Western commodity traders couldn't simply ship metal to Shanghai and expect to find buyers at premium prices. The arbitrage was visible, but not executable. This created a bizarre market condition. Two exchanges pricing the same commodity based on completely different realities. COMEX reflecting paper market, selling pressure and algorithmic momentum. Shanghai reflecting physical supply, scarcity, and urgent industrial demand. The gap kept widening. December 29th, the divergence hit its peak. COMEX silver, $75.12. Shanghai physical, $89.40, 18.6% premium. Western financial media barely noticed. Year-end market wrap-up articles focused on annual returns. Commodity analysts were on vacation. The few market commentary pieces published during Ghost Week characterized silver's decline as typical year-end profit-taking. But in Shenzhen, in Guangzhou, in Shanghai, procurement managers were approving emergency purchase orders, factory owners were authorizing premium payments, supply chain executives were securing 3 months of forward inventory at whatever price domestic suppliers demanded. They weren't reading Western market analysis, they were reading the calendar. January 1st was 3 days away. The export licensing restrictions would activate. The window for opportunistic buying was closing. Whatever silver they didn't secure by December 31st, they would need to source entirely from domestic suppliers in a market where 663 tons had been exported in October. The urgency wasn't theoretical, it was operational. A solar panel manufacturer in Jiangsu province paid $89.40 per ounce on December 29th for immediate delivery. That same manufacturer's competitor, who decided to wait until January to reassess prices, would spend the first quarter of 2026 trying to source silver at over $95 per ounce from the limited domestic supply. The December premium wasn't price gouging, it was the cost of certainty. And while Chinese buyers were paying for certainty, Western algorithmic systems were generating sell signals based on price momentum. The machines couldn't understand scarcity, they only understood downward price trends. By December 31st, as Ghost Week ended, COMEX silver had dropped 6.8% from its December 20th close. Western technical analysts would classify this as a bearish breakdown. Chinese industrial buyers would classify it as the final opportunity before supply constraints became permanent. Both markets were looking at the same metal, but they were seeing completely different futures. The Ghost Week divergence ended on January 2nd, 2026, not because markets corrected, but because the strategic window closed. Chinese export licensing requirements took full effect. The regulatory framework Beijing had announced in October became operational reality. Any silver leaving China now required government approval. Processing times ranged from 14 to 45 days. Approval criteria remained deliberately vague. The message was clear without being stated. Silver was staying in China. By January 15th, COMEX prices had recovered to $81.30. The Ghost Week suppression had evaporated. Western markets were slowly recognizing what Shanghai buyers had understood in December. Physical silver was becoming difficult to source. But the damage had already been done. The manufacturers who waited, who trusted COMEX pricing signals, who believed the bearish technical analysis published during Ghost Week, they were now facing a different market entirely. A Shenzhen electronics manufacturer provides the clearest example. In mid-December, their procurement director reviewed silver requirements for Q1 2026. Annual contracts were expiring. New supply agreements needed negotiation. The director saw COMEX prices declining. Technical charts showed bearish momentum. Market commentary suggested further weakness ahead. The decision seemed rational. Wait for lower prices in January before committing to new contracts. By January 20th, that director was paying $94 per ounce for spot delivery from domestic Chinese suppliers. The delay cost his company nearly $20 per ounce compared to December's $89 premium pricing. On a quarterly requirement of 200,000 ounces, that decision cost $3.8 million. This wasn't an isolated case. Across China's manufacturing sector, the same scenario repeated. Companies that bought in December paid premiums but secured supply. Companies that waited paid higher premiums and faced allocation restrictions. The business calculus had shifted. Traditional procurement strategy says buy when prices are falling, wait out market weakness, negotiate from a position of patience. These principles work in markets where supply responds to demand signals. But Ghost Week 2025 demonstrated a different reality. When governments coordinate supply restrictions, when regulatory changes override market mechanisms, when strategic timing matters more than price momentum, traditional procurement logic fails. The manufacturers who recognized this, who understood that $89 with guaranteed delivery was cheaper than $94 with uncertain allocation, They maintained production schedules through Q1 2026. Their competitors faced different outcomes. By February, Chinese domestic silver prices had reached $97 per ounce for immediate delivery. Some industrial buyers were reporting 4 to 6 week delays in securing allocations. Production lines were adjusting schedules. Output targets were being revised downward. The ripple effects extended beyond China. Western manufacturers dependent on Chinese component suppliers began experiencing delays in Q1. A German automotive electronics firm reported delivery postponements from their Guangdong supplier. The supplier cited temporary raw material constraints. The automotive firm's procurement team investigated. They discovered their supplier had delayed silver purchases in December, expecting lower January prices based on COMEX futures trends. That delay was now cascading through international supply chains. This is where Ghost Week's strategic implications become clear for business operators globally. First implication: price discovery mechanisms are breaking down. For decades, COMEX futures prices provided reliable signals for physical commodity planning. Industrial buyers worldwide use these prices for budgeting, procurement timing, and contract negotiations. The assumption was simple. Futures prices reflect supply and demand fundamentals. Ghost Week 2025 destroyed that assumption. When paper markets can diverge 18% from physical markets, when algorithmic trading during low volume periods can suppress prices while physical scarcity intensifies, when government coordination can manipulate timing to exploit seasonal trading patterns, futures prices stop reflecting reality. Business operators can no longer rely on Western commodity exchanges for accurate supply signals. This forces a fundamental strategy shift. Instead of watching price charts, companies must monitor physical inventory levels, regulatory announcements, shipping data, and warehouse stocks. The analytical burden has increased dramatically. Second implication: seasonal vulnerability has been weaponized. Ghost Week isn't new. Reduced holiday trading volume happens every December. What's new is the recognition that this seasonal pattern creates strategic opportunity. Beijing didn't create Ghost Week. They exploited it. The October export surge, the December accumulation, the regulatory timeline, all coordinated around the knowledge that Western institutional oversight would be minimal during the final week of December. This creates a template. Other commodity-producing nations are watching. They're studying Beijing's execution. They're identifying their own seasonal vulnerability windows in Western markets. Ghost Week 2025 demonstrated that coordinated state strategy, time to exploit predictable market patterns, can achieve strategic objectives without triggering immediate Western response. The implications for business planning are significant. Companies with commodity exposure must now assess geopolitical timing risk. Are regulatory changes likely to be announced before low liquidity trading periods? Are supply restrictions being coordinated with seasonal market weakness? Are price signals being deliberately manipulated during periods of reduced market surveillance? These weren't questions procurement managers needed to ask in 2020. They're essential questions in 2026. Third implication: the premium for certainty has changed. The Shenzhen manufacturer who paid $89 in December made the correct decision, even though prices were falling at the time. The premium they paid wasn't wasted money. It was insurance against supply disruption. This changes how businesses should evaluate commodity costs. Lowest price no longer equals best decision. Guaranteed supply at premium pricing often represents better value than uncertain allocation at lower nominal costs. The risk-adjusted cost calculation must now include supply continuity probability. A solar manufacturer paying $14 per ounce premium for December delivery secured 3 months of uninterrupted production. Their competitor, who saved $14 per ounce by waiting, lost 3 weeks of production in February due to supply delays. The production loss cost far more than the premium savings. This is the new business calculus. Fourth implication: Western market dominance is being challenged. For 50 years, New York and London commodity exchanges set global prices. Physical markets in Asia, Africa, and South America accepted these prices as benchmarks. The assumption was that Western financial markets, with deep liquidity and transparent price discovery, provided the most reliable pricing mechanism. Ghost Week 2025 revealed the fragility of that assumption. When Shanghai physical markets can sustain 18% premiums over COMEX futures for 9 consecutive days, when Chinese industrial buyers completely ignore Western price signals, when physical commodity flows operate independently of paper market pricing, Western exchanges are no longer controlling the narrative. This represents a fundamental shift in commodity market power. Physical demand centers, particularly China, are asserting price independence. They're demonstrating willingness to pay premiums that Western paper markets say don't exist. Over time, this divergence forces a question. Which market is right? The futures exchange, where algorithmic systems trade paper contracts, or the physical market, where industrial buyers pay real money for actual metal? The answer determines where price discovery will occur in the future. For business operators, the strategic takeaway is clear. Ghost Week 2025 wasn't an anomaly, it was a demonstration. It showed that commodity markets are now arenas for geopolitical strategy, that seasonal trading patterns create exploitable vulnerabilities, that paper and physical markets can operate under different realities, and that businesses relying on traditional market signals, traditional procurement timing, traditional price discovery mechanisms, are operating with outdated strategic frameworks. The manufacturers who understood this in December 2025, who paid premiums for certainty, who recognized that regulatory timing mattered more than price momentum, they maintained production through Q1 2026. The ones who didn't, they're still trying to secure supply.